Trevor here from Cherry Hill Private Wealth. Happy New Year. Hopefully your year is off to a fantastic start. This week, we're going to have a look at the recession, whether this is actually something that's happening, whether there's a possibility of something called a soft landing. Next, we're going to take a look at some commentary on the markets, take a look at what happened in December, what we're looking at going forward for the first quarter of this year. And finally, if you are that type of person that has made a New Year's resolution, we're going to take a look at what most people make the resolutions about, some tips and tricks for keeping that going throughout the year. We've been hearing about a recession for several months now, and back in October of 2022, industry experts such as Bloomberg gave the chance of a recession within the next 12 months 100% likelihood. And although there's never a solitary reason for a recession, the tightening of financial conditions, persistent inflation, war in Ukraine, and rate hikes are all raising the risk of a contraction. Morgan Stanley told investors that they should brace for a much bigger decline in the U.S. stock market than they were previously expecting for 2023. They're predicting roughly a 22% decline from current levels, with the recovery coming more in the latter half of 2023. On the other side, Moody's Analytics is confident that the latest job market reports suggest that the economy may still be able to weather a downturn in 2023 without going into recession territory. So first, let's have a look at what a recession is and what a soft landing actually entails. Essentially, a recession is any significant, widespread, and prolonged downturn in economic activity. On the other hand, a soft landing is when the Fed is actually able to slow down the economy, bring down that inflation, while also preventing the economy from entering that recession territory. There are several highly disputed reasons on why we're at the brink of a recession, such as government measures to offset economic difficulties surrounding the pandemic. We also have supply chain issues, the Russia-Ukrainian war, and then the Fed's handling of the rise in inflation rates. Whatever the reasons, we're in a unique situation where divergent data is suggesting the recession is imminent, while the other is suggesting that a soft landing is possible. Those predicting a recession are largely looking at one of the leading indicators, predictors, which is the yield curve of the 10-year U.S. Treasury bond. The 10-year now yields more than 1% less than the 3-month bill, which is lower than any point that we've seen in the last 30 years. This is typically a really good indicator as it signals a rise in interest rates, which we're seeing now, of course, and that can also slow down the economic growth. The other factor is that financial institutions like banks have little incentive to lend for the long term. And this really means that funding for long-term investments that can spur economic growth just aren't happening the way they would otherwise. Job market, on the other hand, remains strong, with recent U.S. numbers showing almost 250,000 new jobs added in December alone. This brings the overall new numbers to about 4.5 million in 2022. Hourly earnings increased in that same period by 4.6%, but it was less than the downwardly revised 4.8% that we saw in November. All of these numbers are positive for the economy and for reducing inflation. Slowing wage growth is a positive sign for the Federal Reserve, who recently stated that hourly wage growth is still about 1.5% higher than what is needed to control inflation. While according to Moody's Analytics, recent employment and wage trends, along with declines in consumer price pressures, could help the U.S. avoid recession this year. They even go as far as stating that this could see the central bank pause or even reverse some of its aggressive interest rate hikes. So, how is it possible to be in a recession when unemployment rates are at a historic low at 3.5%? Recently, prices for many things have pulled back. The increases have slowed. Gas is a major one, while rent growth is also slowing. And the other commodities have also weakened as well. If a recession is coming, what does this mean for markets? Some argue that the decline in markets in 2022 priced in the recession risk. Others argue that the bear market of 2022 was just a reaction to the rise in interest rates, and there's more downside to come if recession actually hits. Of course, the yield curve could be wrong. It's built a strong track record over history, but there have been many unique events during this economic cycle, and maybe a false alarm from the yield curve could be another one of those. If we take what Moody's saying, the recession seems unlikely if wage growth and inflation subside without lots of layoffs. After making some positive headway in November, markets reversed the course in December. Both the S&P 500 and TSX Composite finished the month down about 5%, while the Canadian Universe Bond Index also showed some declines. While inflation is coming down in the short run, it may be persistent at higher levels due to structural headwinds that remain in place, and that's largely the limited oil supply and tight labor markets in the service sector. Our team mentioned in November commentary that it felt caution was warranted based on their technical analysis. And the reasons why were highlighted throughout December. Reports showing that higher than expected US GDP and core personal consumer expenditures will likely mean the Fed will continue to remain restrictive with its monetary policy. Finally, our team remains cautious so long as the central banks remain restrictive in their policy decisions. We've entered 2023 with hefty amounts of cash in our portfolios, looking forward to investing those in dividend paying companies with strong balance sheets that are growing their earnings and have lower valuations than we're seeing today. All of the WPP portfolios held up really well in 2022, experiencing less volatility than the public equities and bonds, giving more capital to redeploy in the near future. Ever wonder what the origin story of the New Year's resolution was? We're going to find out today. The Babylonians, believe it or not, were the first to make a New Year's resolution about 4,000 years ago. And I'm sure it wasn't about losing weight or taking that all-inclusive trip that we're all dying to do nowadays. About 40% of adults set resolutions each year. So let's see what they resolve to do and how successful they actually are. Almost 60% of young adults, and that's 18 to 34, make a resolution, while those that are 55 and older are about 3 times less likely to make a resolution. And I like to think that it's that the 55 and over have got it all figured out. It's not that they've given up on making those resolutions at this point. Parents are 1.6 times more likely to make a resolution than those without, which makes sense since those little ones can take a drastic effect on some of the more common resolutions like losing weight, drinking less, traveling more, and things like that. We also saw some changes in the types of resolutions throughout the pandemic for most people. They're now focusing more on mental health, eating healthier, and their finances. So how long do these resolutions actually last? Almost half expect to fail before February, while 1 in 4 are quitting within the first week. A whopping 9% make it to completion with the resolution. So hopefully you're one of those 9%. These resolutions fall primarily due to timing. Most people just aren't ready to commit to the resolutions and lose that motivation. Research has really shown that the best moment to start is whenever you're actually fully ready to commit, not just when the calendar turns over. If you have a New Year's resolution that you want to pursue and actually want to fulfill, start maybe making the goal a little bit smaller. For example, if your goal is to change your entire diet, start by just changing what you eat for breakfast and then go from there over time. Experts cited tips to achieve your goals include deeply understand why you want to change. What's your big motivation? Why is it necessary to change? Set very specific and small goals. Make sure that they're realistic. Consider an accountability partner. This is a big one for me. On those mornings where you don't want to get up and work out, if you have a buddy to work out with or a partner to work out with, it's usually a good motivator for that. If you want to dive more into the resolutions, we've included a link for this as well. Have a look at it. There's some pretty interesting stuff in there. Well, that's it for this week. See you again in 2 weeks. Hopefully you're off to a prosperous 2023 and the outlook is going to be great for you. Take care.